All right, welcome everyone. Thank you for joining us today. I am Victoria Kahipe. I'm Associate Director for Physical Sciences Innovation at UC San Diego Office of Innovation and Commercialization. And Donna Shaw here is hosting with me. We're fortunate to have today's webinars presented by Osage University Partners, or OUP. OUP is an investment firm that focuses on startups developing pioneering technologies from top research institutions in partnership with university tech transfer offices. UC San Diego is a core partner of OUP, along with other UC campuses, as well as MIT, Stanford, Harvard, and others. Since 2009, OUP has been the most active VC investor in university startups. From 12 to 1 p.m., we'll have the Founders Equity webinar that will be followed by the CEO assessment webinars between 1 and 2 p.m. The life sciences folks will stay in the Zoom link, and the physical sciences folks will have to move on to the other Zoom link. We have two speakers from OUP. Donna, would you care to introduce the first speaker?
Yes, I would be happy to do that. So I want to introduce you to Anurag, who is, as you can see on the screen, a principal for OUP, managing the life science team. And he started in this space with OUP in 2017. Prior to that time, he was a consultant at Boston Consulting Group, where he worked on life science investments and corporate growth strategy, business development, and so on. And his background is in molecular cell biology, which he attended and received his PhD at Washington University, which of course is in St. Louis, in the Midwest, near and dear to my heart because I'm from Chicago. And he received a bachelor's in technology and biotechnology at the Indian Institute of Technology. So we are very, very happy to have someone with credentials like this to be part of our panel today. And welcome, Anurag. And Victoria, would you like to introduce David?
All right, not to be outshone. David Dorsey is the principal at OUP for the technology team. He joined OUP in 2016 with focus in networks, wireless technology, signal processing, and machine learning. Before joining OUP, David was a lead engineer at Lockheed Martin, where he served as PI for multiple DARPA and DoD programs. David holds a PhD in electrical engineering and a bachelor's degree in computer engineering from Drexel University. So without further ado, take it away, David, and Founders Equity.
Great. Thanks for having me here. We're going to talk, the first part of this is going to be a talk about equity for founders. And, this is typically, a talk that we're gearing towards an audience of people who are PIs, who are considering commercialization, or people who are involved in an academic spinout or a university spinout. So we'll start with the first slide here just to kind of give some background about, sort of how we think about equity and why give equity in the first place. So, when you first start a company like this, you have a great idea. You may have some data that shows that that is an idea that works. You're developing use cases. You may have talked to some potential customers and they've validated these use cases or your value proposition. But what you don't have a lot of is money. And so you can't really pay high salaries. And so what we think is important here is to consider equity like a scarce resource. And because it's the only one you've got, essentially. And you're giving equity away in order to get, first of all, to reward past performance, and also to incentivize all the future performance. And here's where you want to be mindful not to underestimate the amount of work that goes into taking a company from 0 to scale. Like, it's going to take a lot of work. It's going to require lots of additional expertise and recruiting talent and bringing on lots of additional capital. And so part of what I want to cover here is actually to to think about how to split your early initial equity up among founders, with a mind towards what you're trying to accomplish. And so we can start with, I guess, some initial data about what we see typically in initial founder splits on the next slide. And here it shows that you kind of break it up into, you've got your lead founder, CEO, and sometimes this is a full-time PI who's turned CEO. That's sort of a rare case, but otherwise you have kind of lead founders in this big chunk of 40%. That could be 2, 3 people. Sometimes it's as many as 4 or 5. Then you're also bringing on key employees. This will be like C-level executives or VPs or just initial employees that are brought on, and that typically will take up another 40%. Those two 40%, that 80% there could be 4 people total. Right? It could be 8, it could be 4, it could be 3. I mean, we're not talking about a lot of people here. And typically what you see is that the initial splits kind of, taking up 80%. And then what you usually want to do is set aside 20% as part of an option pool. And an option pool is to allow you to hire new talent and give them some grant of equity, and also to incentivize employees, with bonuses of equity when they perform. Every time we do a financing, you will also increase that option pool in order to, and everyone in the team will suffer additional dilution for that, but you will do it so that you'll help and keep employees motivated and incentivized, and also help you recruit talent. The key thing to remember here, I think, about option pools and recruiting talent is that in most cases, people are not joining your startup because you're paying top dollar for salary. Like they're not going to be jumping in this because they think that they're getting the highest pay. And in fact, you should probably be a little wary of people who are asking for really high salaries. What you want are people that are all on the same page as you, and they're taking lots and lots of time and energy into something that will be worth something later. Okay? So let's put some bounds on this data here. And this chart is actually just to sort of elaborate on the initial chart here. So those colored dots represent the equity stake that's being given to each one of these positions: a founding CEO, a PI founder, and a passive PI. And I'm going to get into like what I mean by an active founder and a passive founder. But the different colors represent the number of founders total. And what you see is there's a wide variance here. But in general, the founding CEO, like if there's a founder who is also CEO, the person is generally taking the largest chunk of equity. And then all other founders will take a bit less. But there's obviously quite a bit of variance here. Again, we're talking again, we want to reward for past success. We want to make sure that we're incentivizing future performance. No one, so if someone is a founding CEO, which means that they helped found the company and they're going to lead the team full-time going forward, that is rewarding past success and also incentivizing the future performance. What you want, you also will see like graduate students will take on the lead role for the early start of the company sometimes, and they will also be given a significant amount of equity. But every situation is different, and so you have to think about it that way. The thing I want to say next though is to kind of dig a little bit deeper into what I was saying before about a passive versus active founding scientist. So in the next slide, we have a little more of a breakdown here. And maybe I don't want this.
Just one thing to point out, like in the different founders, that's the difference between a patent and the founding equity. In the patent, if anybody has contributed anything, you kind of have to have them as a co-inventor. Here, we have to give a little bit more granularity to what their role is, both in the past and in the future.
That's right. Yeah, that's right. So, I wanted, first of all, this isn't meant to be prescriptive, but this is a table that is kind of giving a sense of the range for founding CEOs, active founding scientists, passive founding scientists, C-level, what the university takes as its stake, engineers. These are kind of initial grants of equity that you'll typically see. And obviously there are a range, but the one I wanted to kind of zero in on here is the difference between an active founding scientist and a passive founding scientist. When someone is full-time on the company going forward, and you give them a big chunk of equity, that makes sense. You're incentivizing future work. And really, they're important players in the team. They're going to be staying up all night. They're going to pull 100-hour weeks. They're going to do all the things that that's necessary to make this a successful company. A passive founding scientist is someone who's typically an advisor. It could be a day a week, 20% of their time, because they're keeping their university position. And I want to be careful here, but what you really don't want to do is give a lot of equity here. Typically, the range that we see is between 1% to 5%. And the reason why is because you're also trying to, again, incentivize future behavior, future work. And so giving a big chunk of equity to someone who can't spend full time on this for the future could be a mistake. And the reason why is because you really need that equity elsewhere. It's not as though, again, going back to this is a scarce resource, and you really want to be careful about how you're splitting it up in the beginning, because you want to incentivize people who are going to be full-time 100%. That's why it's really important early on to have the conversations, and sometimes they're tough conversations with people about, what is your future role going to be in this company? Like, are you going to quit your day job? Are you going to put in 100% of the time? And we need to think about that as we're thinking about equities and the consequences of allocating the equity. So the next slide kind of gives some of the consequences of different kinds of equity allocations.
Maybe just to add one more piece here, it is one of the scenarios we encountered recently was the equity was offered pretty evenly when the company started, but over the years the company pivoted and the role of different founders significantly changed, and that led to a very different cap table compared to what investors would have liked. So sometimes even you can do all the right things, but the over time things may change. And so, between the founders, that's where the understanding has to be good, so that if things change, these things can be adjusted later and everybody's aligned. What is the, what is the guiding principle of what we should look like in this equity? So something like, we just encountered and we had to have the discussions with all the founders to change their equity. And actually everybody was, worked very well together. So even though things are done right the first time, over time it may change.
Good. So I don't like the term parasitic, but often what we do is we describe a sort of cap table that's, equity that's given on the cap table to people who aren't really active, super active in the company. They'll often call it parasitic founders. We also have parasitic investors too. One of the things you have to understand is that once you grant equity, it's very difficult to take it back, especially after an equity financing. You have a cap table. It's almost impossible to get them off of the cap table once you've granted that equity, with the exception of a recapitalization. So the other problem you could run into is that you run out of equity for compensation. So once the options have been issued, the company has to expand their option pool to compensate future employees. But every time you do that, you're diluting an existing shareholder. So there's a consequence for that as well. And then it's a drastic measure to get someone off the cap table, but often, not often, but sometimes you will see companies engage in what's called a recapitalization, which is really painful. That's when you're issuing lots and lots of new shares in order to dilute everybody down close to zero, and you're basically starting from scratch. And no one is happy about that. So it's certainly a situation you want to avoid. Again, being mindful of how you're giving out initial equity. And then I was saying before, also the same consequences are for bad investors. So we should probably consider that as well on the next slide. So bad investors mean, later on, you're going to bring in investors. They're going to be on the cap table with preferred shares. You want to look at things like how big the fund is, whether they follow on, if they add value, can they help with recruiting? You should think about investors the same way you're thinking about new hires. They're going to be on the team, they're going to be on the cap table, and they're just as hard to get rid of. You want to think about how they're going to add to the culture. if they have a board seat, whether or not they'll have obstructive behavior. They might block a sale to a potential acquirer or push for one. And part of that happens because of the things like misaligned exit horizons. Like they expected the company to sell in 3 to 4 years, and you were thinking this was going to be a long-term expenditure, and it was going to exit at a much higher valuation. They have rights of first refusal. You have to think about voting thresholds and also liquidation preferences. We'll talk more about those later, but just unusual liquidation preferences sometimes get stuck in some of these early rounds by investors that that have unusual term sheets. And first-time CEOs may not be aware of the implications of some of the terms in the term sheet. So we'll go. This is just a high level. We'll dig into scenarios in more detail later on. But this is just to give an idea of how ownership sort of changes through different rounds. So when a company starts off at its seed investment and has kind of a low valuation, so $4 million pre-money, it's raising $1 million, and the dilution here is 20% because it's the amount of the investment divided by what's called the post-money, which is the size of the investment plus the pre-money valuation. So in this case, it's 1/5. And so that's a 20% that goes to the seed investors. And then the option pool is 20%. And the co-founders and employees that are not the lead founder or CEO is another 30% now because they've been diluted. And the founding CEO is at 30%. And then you look what happens in a successful outcome. A tech startup can raise $40 million across 4 rounds of financing and exit around $240 million. That's a successful exit for a company. And at that point, the CEO is owning about 12%. The employees own the other 12%. The option pool is cashing out, it owns in its 8%. But the investors, the equity investors now own 68%. And we'll talk more about what that means and how they get paid first according to the liquidation preferences. But you're going to take substantial dilution every round from refreshing the option pool and for new capital so that you can pay salaries and the operating costs and continue the business. And so what you also want to think about here is sort of the dilution that you're taking to give it to a founding member who's going to be really, really active is really small compared to what you're going to be giving away to the equity investors that are going to help you along as well, right? So you want to be mindful, like this is all relative, right? It's a scarce resource, but you have to think of it sort of in the context of how much you're going to be giving away to investors as well. So again, that's why you also want to do your diligence on investors because you're going to be inviting them onto the team. They're giving a significant chunk of the company away.
David, maybe we can take a further a few questions that we can address. So I think the first question has been what about founding faculty advisors, those whose patents are foundational to the company? I think that's the question. And what equity should they get?
Do you want to take that?
Given a written response, so I just wanted to make sure that you had a chance to opine on it as well.
This is I'm sorry, this is from Vineet. This is the.
Yes.
Yeah. So so I could be talking to the founding CEO or the PIs. So in this case, I'm thinking about the people who are thinking about founding the company. So that could be a PI who is going to eventually bring on an outside CEO. And so the U is actually the PI. I'm thinking about the PI is trying to decide how much of the equity stake in the company they should give away for a high quality CEO and how much they should be thinking they're going to be giving away in terms of an option pool and how much they're going to be giving away to the initial investors. So what I want you to think about is how much of the equity stake in the company you're going to give away to someone who can help lead this operation, assuming you're going to be passive and advisory. Does that make sense?
And David, there's another question that I answered in written, but would love to get your thoughts on it. Is how do you define founders, what is the threshold you'll use to give anybody a founder title?
Yeah, I mean, for me, the the founding team are the people who usually have come up with the idea. The idea is theirs, and they have also decided they were the first people who got together to decide to take this company, to make it a company. To me, I mean, it's the initial people who decided to form the company. So the founding team members are the ones that are putting all the work in the early stage. Some of those may go on to be full-time founding members in the future. And some of them may be again, it could be a professor who is going to have an advisory role in the future, but it's still a founding member.
Yeah, and I think that, for an investor, I think what is critical is what is the equity divided, and are they been allocated with the right incentives? So I think if you look from an investor perspective, that is more critical than the title founder given to more people. And I think the founder title should be going to not only people providing the technology, but also kind of putting in the effort in the early days to come up with a business plan, come up with a strategy, and so on. So I think, even in the academic world, if somebody is helping who is not really provided intellectual property, but put together the plans and the presentations, I think can be deemed as a founder. And then, but the equity division is what becomes critical for investors to look at.
Someone else asked a question here about preferred shares and common shares. And so it's a quick answer. So someone was asking, can you just do away with preferred shares and have the whole cap table common shares only? Yeah, if you don't go out to VCs to raise capital. So there are angel investors. There are other kinds of investors that do sometimes take common shares for equity. But generally speaking, venture capital funds are going to purchase preferred shares, and so it's really unavoidable once you go out to traditional VCs for funding. You can negotiate the terms, right? And you should make sure that the terms make sense. But in general, as long as you're not bringing on a venture capitalist, you can keep the whole cap table common share, sure.
Yeah, and then maybe the last question, David, we can answer is in what scenarios have you seen university founding equity stakes as high as 30%?
Personally, I've never seen that actually. So I don't know if you have.
No, I mean, that's what I was surprised that was it there on any of our slides, because it was referencing the slide 9, and I think the 30% is for the lead founder and CEO.
No. Actually, on this slide, it does say some 30% max on the university founding equity stakes. This comes from data, by the way. Like I didn't compile the table, but the table comes from data. So there may be one outlier exception where 30% was given to the university founding equity stake. That is certainly not normal. Yeah, that's an extreme.
Yep. And maybe last before we move on is how does the equity change after IPO? And I think that is when everybody converts into common shares. So it really doesn't change your equity, but it's more that there is no preferred shares in the common shares. All the shares are just common. And I think the last part of it is, can you exit early? I think you can exit whenever you get a right offer. It could be without a funding round itself. So there is, I think the bar for exit increases as you take more investments, because the investors are looking for a return, and therefore the exit bar or the level of the exit increases. Once you take $50 million, now an exit of 40 million doesn't make any sense. But if you have not taken any money, a $40 million exit is an amazing exit for the founders of 3 founders who own 30% each. Even it's a great exit. So I think you can exit anytime. It's just that the level or the size of it changes as you take more investments.
That's right. Yeah, and again, that's why you want to be on the same page as these investors about exit expectations. They're paying a valuation with an eye towards a particular exit and return on their investment. So you want to be on the same page. The other thing I would say is, like, very often, I don't know if this happens in life science so much, but you see it in tech, where I'll be talking to a professor about a startup that they're putting together, and they've got an outside CEO and they've got a few customers, and then I'll say, well, let me know when you're getting your financing together, and then I'll touch base with them again and say, hey, how's the financing coming along? Actually, I don't think we need to raise. We have one customer, it's a lot of revenue, and then the next thing you know, they're being acquired by their main customer for a really good return for all of them, because they didn't raise any capital, they didn't give any equity away. And so sometimes there are companies that never need to go out and give away equity and offer preferred shares to anyone, because they were able to find a good enough customer.
I think the earliest stage is just licensing deal, right? Like there is. So I think the earliest stage is a pharma company, like for life science, a pharma company is licensing your technology, and the split between university and you can be 80-20. And so even a $10 million or $5 million upfront can seem very attractive at that point. So there is no bar for that. I think we should continue, as we have quite a bit to cover, and I'll keep track of the questions.
Yeah, and some of the other questions actually are asking about sort of founding characteristics, and I think you're going to get into that when you're talking about hiring a CEO anyway. So this slide here is actually touching on an important point, because we're talking about the importance of the CEO and the importance of having someone who could drive value going forward and bringing on the right investors. But there's also you also want to highlight the fact that the value of the scientific founders is also really important. In tech, some of the professors will spend 1 to 2 years of leave. Different universities have different rules, but some of them will allow them to go on a 1 to 2 year sabbatical to help start the company. And so they'll spend a significant amount of their time in the early years. But once they return to the university, it's challenging for them to stay up to date with what's going on with the startup. But at the same time, they can work on the R&D that the company really can't do itself. The company is actually trying to move towards creating value. It is not going to be spending as much money on fundamental R&D, which actually might create additional value. And additionally, it creates a pipeline not only of innovation but also of recruits for the company, so the company can hire out of this pool in the lab. So it is actually better for everybody if the company keeps a close connection to the professor and the laboratory. And so you want to maintain connections, you want to give options, you want to give equity to the founding scientists, even if they don't decide to go on full time, because you want them as an advisor and you want to stay connected to their laboratory. All right, go to the next slide. And one other thing to mention here about incentives is the option pool. So in general, what you're doing is when you hire people, you give them some equity grant according to the table that we showed earlier. And then when you give promotions based on performance, you should. I mean, these are kind of rules of thumb. For outstanding performance, to incentivize employees, you should look to give grants to 10 to 20% of your top employees. That would be about the size, like 50% of what the initial grant you would give to a new hire in their position to keep them motivated. And then also, there's suggestions here for providing employee 1/4 of that new hire grant as a way to refresh their options and keep them focused on the exit where they're going to get a payout. All right, go to the next slide. So look, in general, what we're trying to say here is that we want you to be sort of thinking about dilution in terms of the value that you're bringing to the company. So capital gives you time to operate, operating expenditures, capital expenditure money to keep the company going so that you can continue to create value. The value of the company is a function of things like revenue, the product market fit, the CEO's experience, whether the market is big enough, and the valuation is what is going to determine how much dilution you're going to take. And so every time you go to make an investment, you should take investment from a VC. You should be thinking about how much value can I create with this money, so that the next time I go out to raise, what the valuation would be, and always have an eye towards the exit. Always consider, I'm taking this capital at this valuation. What does my exit have to look like in order for me with this dilution to see a good return for myself? And so you should do the math, right? Because the investors are doing it as well. And the next slide is sort of the obvious takeaway here is that, what we're trying to do here is we're trying to get a slice of a bigger pie and not to own the whole pie. And so you should be always willing to give up some equity here in order to create more and more value, because it creates a better outcome, not only for you, but for your investors and your co-founders and everybody else you bring on the team. So in success, everybody's happy. All right.
David, maybe we can answer the question of what sort of stock grants and option levels would you award to board members?
Yeah, so for board members, I actually don't know what the values typically are. I mean, usually what you're giving them is stock options. But I don't know. Anurag, do you have any notion of what the board members are typically getting for compensation?
So I think board members, it depends. I think they come in two flavors. One are chairmen who are really operating, they're engaged with the company much more. I think they get much higher equity grant. And these are all option grants, like the employees' options they get. So they, from the flavor of it, they're similar, but I've seen anywhere you can give up to 1%, 0.5% to 1% to a chairman. And I think for the other independent board members, or somebody who's, added for specific purposes, can get anywhere from 0.1 to 0.25%. But the investors who, as a part of their investments, come on a board, they usually don't get grant options. That is the agreement, a part of the investment. It is more for the independent board members who are given stock options.
Okay, good. All right, I'm going to try to go through the next section quickly because I think we're going to run out of time. And so I'm just going to talk a little bit more about dilution. And mainly what the takeaway here is, I actually want to sort of bring attention to liquidation preferences and what they mean, and the significance they have. So this is one of the main terms that you really want to look out for in a term sheet. Typically, what you're going to see is, so first of all, liquidation preference says who gets paid first and in what order do people get paid. So starting at the bottom, a non-participating preferred means that the preferred shareholders get paid first at a liquidation. So you sell the company, they get their money back, 1x, and then, or they can convert their shares to common and take their proportion of the shares just like everybody else. So if they own 10%, then they'll get 10% of the total exit value. A 1x participating preferred means that they can get 1x and then they can convert and take additional value from the exit there. In general, I don't know if this is true on the life science side, but on the tech side, non-participating preferred is really the standard. And you want to be mindful of things like participating preferred with multiples, especially ones above 1. And part of the reason, especially at the early stage, is that you get this phenomenon where investors in later stages are going to want to stack the preferences and basically going to want the same deal that your initial investor got. And so that will multiply over again and again over every series after that. And so you want to be watching out for any terms that are kind of out of the ordinary. The liquidation preference is a big one to pay attention to.
Yeah, I think in the life science side now, any sophisticated investors will look for a non-participating preferred unless the company is in some kind of trouble, where we kind of put a preference stack of participating preferred language. Just one thing I think before we move on, David, one question was, how does the equity distribution differ between life science and physical sciences? And I think there is a big gap. There is a very large gap between the life science and tech. So for example, very early stage Series A, investors can own 60 to 70% of the company. And that's not even, with additional 10 to 15% keeping in the option pool for the employees. And so the dilution for the founders are very significant. On the other hand, I think on the tech side, the equation can be flipped, that the investors can keep 30 to 50% of the company, and with the remaining staying with the founders with some option pool. So I think the math is a little bit reversed in the physical sciences versus life sciences, and there's a good rationale for it. I think the tech companies because they generate revenue most of the times, they don't require that much cash to scale up early on before they can be self-sufficient or they really get into the growth phase. However, life science side, the capital requirement is very intensive. And that's why, the dilution to the founders are significant because the development is just significantly more expensive than what is on the tech side. I don't know, David, if you wanted to add
No,
anything.
I completely agree with that. I would say maybe the exception is there are some tech companies that have all of the same characteristics as a life science company. They're hardware, they don't have revenue, they're going to take a long time to get to revenue. I mean, that's still, sometimes just because of the market that we're in with on the tech side, it still doesn't stop them from having higher valuations and sort of letting founders, take much more of the ownership. But there are cases where you'll see sort of valuations go up slowly. But yeah, I would agree. Like life science is different in that respect from tech.
Yeah, I think the bar is how much capital you need to really show the inflection point, and that defines this metric.
Right.
Maybe the last question before we move on is the how do patent agreements between faculty and university impact the dilution? I think investors are completely, we don't look at what's the agreement of how does the royalty get divided between university and the PI. I think investors are completely it's irrelevant for them. For us, the royalty goes out. It doesn't matter from there what happens to it. For us, I think the key question remains is, are the founding members incentivized to root for the success and contribute to the success? And if this is a critical piece for their drive, I think then that can change the equation. But I think that is why we kind of make them whole through equity rather than looking at how this royalty piece may be divided in the license.
Good. Yeah, I agree with all of that too.
Right, I think we can go on.
Good. So again, I want to sort of move through this quickly. So we already showed, the founding structure is 20, 40, 40, right? After the seed investment, it ends up being 33, 13, 27, 27. So the investors are taking 33%, because in this case, actually, the pre-money was 10 million. It's a little bit higher. And they're raising 5 million. So the terms here, let's go to the next slide. So the terms for the seed were a preferred 1x. And so that's a sort of standard. You can either take the 1x or they can convert to common. In the Series A, they have added a participating preferred 1x, which means they get their 1x, they get their money back, and then they can also convert to common and get the kind of payout the same as any of the other members of the team. And so now let's move to the next slide when we think about an upside. So this is what it looks like in a good scenario. You've exited for 250. You have raised, $75 million. Or no, I'm sorry. If you've only raised $20 million, you have a $250 million acquisition. So this is a good upside here. So you're asking the lead founder / CEO is getting, I think, I can barely see it, I think a $50 million payout. The co-founders' employees are getting splitting up the same $50 million payout. There's 25 million in the option pool that gets distributed out to the rest of the team here. And the investors are making $125 million back from this investment. So everybody's happy here. You've cleared the 1x preferences. Everybody's kind of converting to common and taking their equity. And taking their share of the overall exit. So now the one you want to be mindful of, and this is, you want to model both of these out, is the down case. You also, this is where these terms like participating preferred 1x versus preferred really matter. And you see here on a downside case here, where the startup was acquired early for $25 million, which is the total amount that was invested in by the investors, in which case the investors are just basically going to take everything, with the exception of a small amount that goes to the CEO and the founders and things like that. So the effect of the participating preferred 1x here was meaningful. And so you want to be careful of those terms because those terms matter when the exit isn't, as big as you would have liked. They really could be painful.
And I think this is all, this math really works on how much have you raised. Even with a $250 million, if you've raised $200 million, I think you'll end up with the same math here because most of it will go to the investors first because of the participating preferred. And so
That's right.
As you take the money, that really does impact on what your exit has to be to get a payout.
Okay. Yeah. So just to kind of finish this up, key takeaways here is, dilution is necessary, right? You're going to have to take dilution to get to a large exit. The key terms that control payout have to do with the dilution, like Anurag was saying, also, the amount that you raised divided by the valuation. Look out for liquidation preferences, especially participating versus non-participating preferred. Strange terms rarely go away, and so pay attention when you're accepting them. And just remember that investors get paid out first. We do the math to try to figure out what we're probably going to get in an upside and a downside case, and you should do the same math. And Anurag and I are always willing to help out early stage companies are kind of thinking through this when they get a term sheet. So feel free to reach out.
And just one question came in: how do you push back on a 1x participating preferred? I think it is no different than any negotiation you have with the investors. Having another term sheet on the table is one of the best ways to negotiate. The second is just kind of talk about, that 1x participating preferred just misaligns our incentives a little bit. And so to be completely aligned, we should be, dipping into the pot equally, and we both would be pushing for the same exit. And I think investors understand. So I think, and you can say look, the market, we've talked to the other entrepreneurs who have raised funds from similar VCs and they have got the same deal. Now, in the end, remember, it's about the supply and demand. For a VC, there may be more supply. And for you, the demand has to be high for you to negotiate. So, more investors want to invest in your deal, you have more negotiating power. And if you're at the mercy of one, then it becomes a little bit difficult. But I don't think there is any set ways, except what we talked about up front.
I would just add to this that, to kind of take the emotion out of it, what you really want to do is model it out for yourself and discuss that model. And the reason why is because, 1x participating preferred, what that does is it creates for the investor what's called a zone of indifference about exits. So in other words, they'll get paid out exactly the same for a large array of exits. And to them, a $35 million exit is the same as a $65 million exit sometimes, with because of the zone of indifference that's created due to this 1x participating preferred. And so what you want to do is have a discussion with them about that fact, you're misaligned on exits. And so it's not a great way to start a relationship. So you want to maybe talk about the fact we would like to all be on the same page. We want investors that are incentivized to get as big as an exit as possible and don't have, are indifferent to something at a 35 to say a $65 million exit, like a big swing like that. So that's not guaranteed you're going to win the negotiation. I'm sure they've done the model too, but it is better to talk about data than talk about, emotions.
And David, I think the other question that came in was, how much does a granted patent increase the valuation, say in the life sciences or in technology like Internet of Things? I can say that in life science, patent is everything. The valuation without that is zero. So I think all the valuation you are getting is based on that patent. So there is no increase from having a patent. I think there is only a decrease without a patent.
Yeah.
But I think tech side may be a little different.
Yeah, it's much different. It depends on the technology, whether the patent is really creating a true differentiation. But in reality, unlike life science, the best technology doesn't always win out in the marketplace. And so what we're interested in, actually more important than the patent protection, is actually whether or not this team can take this thing to market and beat out competition and other things like that. So it's not the number one concern. It's just, and sometimes in some cases it's one of the last things we're going to look at.
All
So
right.
I should probably turn this over now to Anurag, who's going to talk about potential CEOs and how to do a CEO search. And yeah, because we're running out of time here, I may have to jump off early to go to the next
Yeah,
webinar.
maybe David, we can just take the next 2 to 3 minutes and see if anybody has any questions, because then we would be going. I think the physical sciences would be going to a different Zoom link for the CEO discussion there. But if anybody has any question on the equity, I think over the next couple of minutes, maybe we can wait and see if something comes in. And I think just in the chat room, somebody has posted a link to the physical sciences CEO selection talk. So if you're interested in that, you can join that in the next couple of minutes, and we can take a 10-minute break before we get started with that, so that everybody can use that. Donna and Victor, up to you guys.
Right. So I guess those who are interested in the CEO assessment webinar for the case of life sciences, they stay in this Zoom link. And for those who are interested in CEO assessment in the case of a tech company, would go to the other Zoom link, which has been posted in chat there. And it's also on the webpage for this webinar, I believe.
David, a couple of additional questions that have come. Do founders go through vesting? Yes, I think there are some founder stocks that are given that you can decide to vest or give it out completely. Most of the times they are. I think for the scientific founders at the founding of the company, they're allocated. And I think some of the stocks that are given after some financing as options, and those are vested. And typically the vesting rules are 25% at the end of the first year, and then monthly after that, so that you can vest entirely over 4 years. So that, I think that's a standard vesting, and it just, again, nobody can take the stocks and run away tomorrow. So you need to have continued involvement.
I've seen investors actually focus in on this, especially with actually academic PI founders, because they want to make sure that they stay around to help the company out in the long term. And so what they'll do is, they'll have 3-4 year investing of vesting, and then if the company exits early, they'll accelerate them to 100% or something like that.
I think the last one question I'm seeing is, what are some example of the weird terms? I think that can be a long discussion. I think the key things to pay attention to is to participating preferred. What is the voting rights to get a decision? And I think third one, very critical one, would be is anti-dilution. And I think, we may need to go into much more details to kind of think about that, but ask your lawyers to kind of pay attention to those 3 items very carefully. David, I don't know if you have any.
No, that's absolutely right. Yeah, those are the sort of most meaningful ones. The other thing I would say is there's lots of template term sheets out there, and like you should look up the terms and just kind of see what's common and what's uncommon. There's a lot of good data out there, but you also feel free to ask if you're getting a term sheet with a term in terms you don't fully understand. Like we may not have all the answers, but we can say, like, that's unusual. Like, you should ask an investor.
One question is, what happens once you are fully vested? I think once you're fully vested, you have all the stock, and so you just wait for those stocks to become more valuable, and then go retire on a beach.
Yeah.
Go ahead, David.
No, I was just gonna say, like, so fully vested stock still means you've got stock or stock options. You either have a restricted stock unit, or you've got an ISO. You've got some incentive stock option, right? At the end of the day, those two things, you pick one of those 2 different kinds of options, usually because of tax purposes and things like that. But at the end of the day, the stock is only valuable if the company exits at a meaningful value, right? So if you aren't fully vested at exit, usually these things accelerate so that you are fully vested when there's an exit. So it's always the exit we're keeping an eye towards here, right?
Right.
But
And
if you
I think
leave,
one thing
if you leave early and the company has not exited, you won't see all of those shares. You won't get all of the upside.
Right. And also sometimes these are, they're exercised at a certain price. So to
Right.
kind of buy them, you have to pay that money,
Right.
which can sometimes be restricted as the company, the more stocks you get later when the company is more valuable, it can be a significant amount of money that you have to kind of pay the company to really exercise the option.
Before an exit. At an
before
exit,
an exit.
Yeah. At an exit, you don't have to buy the purchase the stocks. It gets taken out of the liquidation. Right. Gets taken out of liquidation. But this is also one of the reasons why sometimes people will ask for RSUs because that's an actual stock. It's not an option, and so there's no strike price. It's zero. But ISOs are typical. Like the incentive stock option is the most common kind of options that you get.
One question is the LLC versus C Corp. Yep, investors, I most likely will not invest without a C Corp. So, you can keep it as an LLC or an S Corp before that. And then, investors will make you convert to a C Corp once they put their money in. And I think LLC versus S Corp, we're not lawyers, but I think, LLCs when you don't have any revenue, but if you have something, I think it becomes different. So, lawyers, for me, lawyers are better to be consulted for this.
Yeah. I want to follow up with a couple other questions. Somebody was asking that the full vesting question was actually about like incentivizing them after full vesting. You can always continue to add on additional options afterwards, and they may vest later on, or maybe they vest, maybe they're fully vested when you give them to them, but you can always add on additional incentives after someone's initial options have been fully vested because they're still, it's just more value. Somebody else is also asking, how you can reach out to us. So at the last page of this talk are our email addresses, and you can get our emails also from our website at oup.vc, and you can just reach out to us.
Yeah, and I think if you guys have any follow-up questions, I want to give everybody 5 minutes to take a break and switch the presentations. I think Don and Victoria can share our email addresses and the presentations. And feel
right, so we will take a 5-minute break. But first, I want to thank both of you for this great presentation. I know founders equity is always a contentious issue, and I think you helped to clarify how it should be done and what to look out for. And I very much appreciate it. Victoria, did you have anything else you wanted to say?
No, just same thing. Thank you, Anu and David. I think this helps people be on the same page about founders equity. And I think now David and I need to switch Zoom webinars. We'll
See you there.
Physical sciences, folks.
All right. So everybody else, we're going to take a 5-minute break, and we'll see you in 5, okay?